We call ourselves the Fintech for Fintechs. We are the pipes and plumbing behind the Fintech Brokerage industry. So we've been around for just about 10 years now. We have over 200 clients on our platforms. So we're a B2B2C business. And across those 200 clients, we support about 25 million brokerage accounts, mainly in the US, but globally, we are in 144 countries and custodying over $100 billion in assets. So a lot of people have accounts with us, but have actually never heard of us because we are in the background doing all that pipes and plumbing work. So we're an API-based platform that's going to be account opening. We're going to do all the cash funding, money movements, the market access and trading, the custody clearing, your tax reporting, your cost basis, as well as a slew of other tools around the crypto and trading space. That's who Apex is. That's why we have this data across those 25 million plus accounts. We are able to see what people are doing, right? Across a slew of different business models. Everything from a very small robo with less than $100 in it, all the way through to highly sophisticated traders using margin and options and trading on a very active basis. So we're able to compare, look at by generation, by type of business model or type of brokerage or advisor. We can see exactly how people are reacting to the market. Of those customers that we have, the majority of them are going to be millennials, but we are starting to see more and more Gen Z customers on our platform, which is super exciting because as that generation comes of age and we start to understand more about their habits and how they approach a digitally or mobile first trading environment, which is really what we support, is that those mobile first trading apps. I think we're going to see a very different behavior set between the millennial and Gen Z into the future as they start to make some money and open more accounts. We have baby boomers, Gen X, millennials, and Gen Z in the report. And I think what a lot of people expect to see is millennials and Gen Z in particular responding very differently than older generations. But we've consistently seen over time that isn't necessarily the case. And that's important to us because as we promote frictionless investing for all, I think the media's taken a bit of a tilt that younger generation doesn't know what they're doing and they're gamifying investing. And we don't think that's the case. And the tools that we're creating for our customers to bring out to create financial access, we're seeing people use them more responsibly than I think the media gives them credit for. So not a ton of differentiation between each of those generations. And really what we're seeing is behaviors through different business models right now, given the downward trending market. And I should caveat that with, if you look backwards into the past, we did see bigger differences between how the generations were reacting when the market was on its way up. But I think that you're seeing consistent behavior and call that, the smarter behavior while the market's been on its way down for the last year. The old adage goes that the inexperienced investor will buy high and sell low. We're actually seeing these self-directed mobile-first investors hold on through the recession, right? And so in those self-directed accounts, we're more likely as high as above 85% of positions were held or added to through the fourth quarter of 2022. So at a time when the market was really slumping, we saw a lot of self-discipline for people to hold on and not sell out of those positions. Now, interestingly, when we compare those self-directed investors to the managed accounts or, your robo accounts or somebody that has an advisor, we actually saw more activity through the downward trend in the fourth quarter out of those managed accounts. And what you can attribute that to is the rebalancers that are looking at things like tax loss harvesting, or looking at the drift of the portfolio distribution and saying, hey, it's a good time to trade right now because there's been a lot of market movement. We expected to see that on the managed side, and we were glad to see that people were holding on the self-directed side. On a managed account basis, we actually saw accumulation. So people were more likely to add to their positions through the fourth quarter. And actually over the last couple quarters that are in the report, in those managed accounts. So they're more likely to build on the same positions. On the self-directed side, yeah, we're seeing people, they're less likely to add to those positions, but they're not selling out of them as soon as there's trouble in the market. And so when we think about, what was a behavior that we did see, what did they do? One of the big things that we noted was Tesla was unseated by Apple in the report, actually. And Tesla had been holding the number one spot for a very long time within the millennial index. And as we thought about what actually caused that, what does that mean? Both Tesla and Apple were down through the fourth quarter of 2022. But what we did see alongside that was other kind of high growth names went out of fashion and had some pretty major drops within the index as well. But we saw the energy and industrial sectors go up. And so that's that rotation from higher growth tech stocks into these more blue chip names. And so our belief is that, part of the reason that Apple was able to unseat Tesla is because these investors were seeing Apple as a blue chip steady name, even though it still had a pretty tough quarter from a pricing standpoint. GE and Exxon were two of the biggest movers there. Of all the industrial and energy names in the index, 76% of them moved up throughout the course of the quarter. We're actually seeing things bounce back a little bit. Fourth quarter was pretty tough. We saw this rotation into more stable blue chip names, such as an Apple. We saw this rotation into more of the energy and industrial sector. I think heading into the winter, heading into some higher gas prices, that could be expected. We'll be curious to see how people move back into these high growth tech stocks that became less popular through the 2022. Now that we seem to have stabilized a little bit here in January and February, are people going to spring right back into them, or are they going to sit and wait for a while? The first one, as you said, is going to be fixed income. So rates are playing a very large role there. We haven't spent a ton of time in the fixed income arena over the last 10 years because no one's really cared. Rates have been low. The market's been strong on the equity side. And so there hasn't been a lot of demand for it. What we're doing right now is looking for strong partners who are going to help us to make the fixed income market feel a little bit more like the equity market, more seamless. Can you trade on an API basis? Can you find more transparency in the liquidity that's out there? Because today, a lot of that market still sits underwater. And then most importantly, can you fractionalize it? Can you bring it to a wider swath of people that don't have as much money to put into each order by fractionalizing that fixed income? Another area where we're seeing a lot of popularity amongst the retail customer base is in alternatives. And this is another area where, what Apex has really done is created efficiency through the use of technology to help proliferate access to markets and drive commissions down and help really make this fintech brokerage movement and this fintech advisory movement. The alt space is still clunky. It's still slow. It's still paper-based. You're cutting checks and docu-signing. So we're working with partners to say, how can we make it so that people can find exposure in other areas? How can we do that in a responsible way, most importantly? Because, as you get away from registered or listed securities, that's going to become a really important piece is are you putting the best things in front of your customers from a suitability standpoint? And then on a secondary basis, how do you make it more efficient, right? The fees are really high in that alternative space. And we are working with much smaller accounts. And so how can we do that in an efficient manner?